What is MACD? Why is this indicator so important in the trading industry? MACD stands for Moving Average Convergence Divergence. It's generally considered as an indicator belonging to the oscillator family, and it's been around before the boom of online trading. In fact, this indicator was developed by Gerald Appel during the 1970s. MACD is often displayed with a histogram, which graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD's baseline. If the MACD is below its signal line, the histogram will be below the MACD's baseline. Traders use the MACD's histogram to identify when bullish or bearish momentum is high. The MACD histogram is the main reason why so many traders rely on this indicator to measure momentum, because it responds to the speed of price movement. Indeed, most traders use the MACD indicator more frequently to gauge the strength of the price move than to determine the direction of a trend. The MACD has many strengths, but it is not infallible and struggles particularly in sideways markets. Since the MACD is based on underlying price points, overbought and oversold signals are not as effective as a pure volume-based oscillator.
Video. We want to tell you in simple words something about MACD indicator with two lines, how to use this indicator, and a few tips as the secret sauce. In the first step, if you do not have this indicator, please download it from our website for free. The download link is below this YouTube video. Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. The MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. The result of that calculation is the MACD line. A 9-day EMA of the MACD, called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buy and sell signals. Traders can buy the security when the MACD crosses above the signal line and sell or short the security when the MACD crosses below the signal line. Moving Average Convergence Divergence, MACD, indicators can be interpreted in several ways, but the more common methods are crossovers, divergences, and rapid rise/falls. There are four essential things to know. Number 1. Moving Average Convergence Divergence, MACD, is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. Number 2. MACD triggers technical signals when it crosses above to buy or below to sell its signal line. Number 3. The speed of crossovers is also taken as a signal of a market is overbought or oversold. Number 4. MACD helps investors understand whether the bullish or bearish movement in the price is strengthening or weakening. MACD is often displayed with a histogram, see the chart below, which graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD's baseline. If the MACD is below its signal line, the histogram will be below the MACD's baseline. Traders use the MACD's histogram to identify when bullish or bearish momentum is high. MACD measures the relationship between two EMAs, while the RSI measures the price concerning recent price highs and lows. These two indicators are often used together to provide analysts a complete technical picture of the market. MACD is not a perfect indicator. One of the main problems with divergence is that it can often signal a possible reversal, but then no actual reverse happens. It produces a false positive. The other problem is that divergence doesn't forecast all reversals. In other words, It predicts too many reversals that don't occur and not enough real price reversals. Anyway, what you do is use the fast and slow line crossovers as a signal for entries and exits. For example, if you want to go long, you wait for the fast line to come from below, cross over the top of the slow line, and enter a buy position. To exit, wait for the fast line to cross over towards the bottom side. This is perhaps the most basic way of trading the MACD. The MACD indicator's beauty is that it can be used as a lagging indicator and a leading indicator. Such an attribute is what sets it apart from most of the technical indicators out there.
Moving average convergence divergence, MACD, is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. MACD triggers technical signals when it crosses above to buy or below to sell its signal line. The speed of crossovers is also taken as a signal of a market is overbought or oversold. MACD helps investors understand whether the bullish or bearish movements in the price is strengthening or weakening. The beauty of the MACD indicator is that it can be used as a lagging indicator and a leading indicator. Such an attribute is what sets it apart from most of the technical indicators out there. Go to forex.in.rs's article and download the free MACD indicator with 2 lines. See the links below the video. Wish you a nice day.